Okay, so today what we're going to be doing is talking about a very important talk that I have with all of my students and my traders every single weekend. Now, something that some people new to this video might not really know is that I run a training academy where I train students in over 28 countries around the world. If you want to find out about that, click the link, the little I, there's going to be a video there explaining everything. I don't want to slow this video down. So we are going to be talking about what we actually do every single Sunday that helps my students. And what I'm going to be doing is giving you a few small pieces that can help you in your week going forward as a trader in the markets. Now, I usually say the word Forex trader. Why do I say that? Mainly because we trade Forex. We trade stocks, commodities, and indices as well, but our main focus is looking at Forex currencies. So what I wanted to do is quickly show you a trade that I'm currently in that is actually in a loss. The idea has not played out, nor has the actual risk of the idea. However, we're still playing into this idea and constantly working on how we can improve it. The thing was that I posted this video up over here, and that video was talking about this idea and how it was playing into the strategy we thought it was going to actually develop into, and we thought that it was going to be a good idea. Now, what I'm going to be doing is blending what I'm going to show you right now, which is my real trading portfolios with real trades and the actual lot sizes to show you what has gone wrong, as well as showing you an excerpt of my trader talk where I talked about the strategy that we're playing into and the risk that we want to take and how we manage that risk. Now, it's very simple and straightforward. I don't usually go too advanced in the traders talks. It's usually the theory and the main academy that teaches them the advanced analytics and risk management processes. But let's quickly jump into this video, and I'm going to show you how we are going to get ourselves out of this trade in a profit. Okay, so jumping onto the charts, you'll see here it's the Aussie dollar, Japanese yen, and I know you're probably thinking, wow, that's a lot of orders, and yes, it really is. However, just to give you a bit of a breakdown, just to verify all of this, you'll see that down below in the description there are going to be links to these portfolios, and these portfolios are a representation of the portfolios that I manage. Now, these portfolios are where I trade in the markets on behalf of my clients. I trade quite a serious amount of capital. And as you'll see, all of these portfolios are showing you the real live verified stats, as well as the equity balance in each of the accounts as a representation of the micro fund, as well as, for example, if you have a look in one of my main portfolios, you can have a look at every single one of the trades that we're executing. So you'd be able to see exactly which trades are doing what the portfolio is in a profit or loss on, and also this is showing you the rolling equity exposure. So for example, if you have a look in this return per trade deviation, all of these red lines you can see over here are losses. However, that's not a realized loss. That is effectively a loss where the portfolio is currently holding an open exposure. However, this open exposure is in a large drawdown, and we now need to cover that position and bring it back up into a profit. Now, prior to this, the entire month, we've had a really, really good month of trading. We've had close to about, I think it's around about 130 transactions on all of these trades on all of these portfolios put together. So it's been a very, very active month. However, the thing is that running up towards now the middle of the month, we've got a position running that is not playing into the idea that we thought it would play into. And now what we need to do is work out how we're going to get out of the trade in a profit. Now, the problem is a lot of traders, sometimes retail traders, will think if a trade is in a loss, they should just cut the trade and get out of it. Now, although I have to be very careful about what I say coming up for the rest of this video, because I'm talking about what people should do with their own money. I'm not going to tell you how to do it with your money. I'm going to tell you how I do it with mine. Now, the thing is that there are two aspects to succeeding as a trader. One is the idea, and number two is the risk. Now, if your idea does not play out, but your risk is perfect, you can still win the trade. And vice versa, if your risk is bad, but your idea is great, you can also still win the trade. So the whole problem of this is we've now gotten into a trade where it's reaching a very extreme level of volatility. We still think the trade is going to play into some process of a pullback that we'll be able to capitalize from. However, if we did not manage our risk correctly, we would actually be in a huge loss. Now, the thing is that if you go and have a look down, we have spiked into just on a 2% drawdown on this trade. So the thing is that we are not losing a huge amount of money. It's literally just 2%. And if you have a look at our portfolios, we do produce quite a good amount of return. So it's not as though a 2% drawdown is a massive loss for us or a massive problem. For example, if you have a look on this portfolio, ILQ Australia, this is a great portfolio that represents how throughout June, July, August, and September, although those months were incredibly good months of trading for me, because I was in a gold position where I went long in the gold markets and the market continued to fall and fall and fall, I held the position, I managed my risk correctly, and then in October, November, and December, I was able to unwind myself from that position and create a huge amount of profit. So those are not realized losses. That is my drawdown where the balance is now below what I've produced in profit every single month. Now, this is how a professional trader manages their portfolio. If they've made $1,000 realized gain, but they're in $1,000 drawdown on a real trade, that means that evens out what the profit in their accounts actually is, meaning what are they? They're break even. So the thing is that even though June, July, August, and September, I had great months of trading, 2 months of which were 100% win ratio months, I still was in a drawdown on one trade idea, but that didn't mean I had to buckle my entire portfolio and I had to risk a huge amount of money to either get into the trade or get out of the trade. Now that is the thing, is if you're risking a very small amount on every single trade and you're actually focusing on yourself saying, well, if this trade doesn't play out, we're going to manage the risk on that trade. We're either going to get out of it or we're going to keep the trade until it plays out. Then it allows you to have the freedom to go to a new trade and keep on transacting and keep on making money. You don't want to take ownership of a single trade. You want to try and diversify across multiple different trades. Now, let's quickly go back onto this trade and actually have a look at what it's doing and how we are going to get out of the position either in a profit or break even. Because now we're down just under 2% loss, which although is very small for myself, I still have to be very careful about what I do next for my portfolio and for my clients as well, because I do have quite a serious amount of money at risk. So as you'll see in this idea, our focus was trying to play into, and like I said, you can go have a look at that video, the top right I button, you can just click on it. It's going to show you this whole trade idea in full, so I'm not going to explain it. However, as spoken about in the video, we noticed that there was a very strong trend developing on this chart. Now, if I show you here and I try and pull it back quite far, I'm not going to be very accurate with let's quickly set that up over there. See, this is the problem about trying to draw trend lines through these zones. Okay, so what you can basically see here is we've got quite a strong downward trend developing, and this is important to realize. You know, if you're going long on a market and the market is falling in value consistently, you have to understand that you're going to land up in, you know, for lack of a better word, shit street from time to time. However, as you can see, prior to this, we have these extreme levels where the market has sold off consistently, but then has bounced up to the upside. Now, what does this necessarily show you? This shows you basically an increased level of volatility where the market is moving into these very high levels and then pulling back incredibly fast into these very low levels. And it's creating a great deal of erratic market movement. Now, erratic market movement is something important for a trader to understand, meaning it doesn't necessarily want to price into that level, but because of momentum, because of volatility in the market, and possibly because of price manipulation, the market is going to play into those extreme levels. And this is what you can see here. So the very left-hand side of the chart, what is this showing us? It's showing us that the market is pulling up into these very high levels and then these very low levels, consistently moving. And now what you can see on the very right-hand side is the market has not really moved by that far again. So you can literally measure the distance here. So if you just take your distance measurement, so it's moving by around about 1400 pips every single time on the daily chart. Now that is quite a lot of movement, but you know, the main goal is, why is it not moving that much now? And the great way to do this is to actually take this trend line. You can literally just copy this trend line here and you can go control. So you just hold your control button and you drag it across. And what is this showing you right now? This is showing you that the current price channel, so this price channel, that's really the distance of the price channel. And if we took something as simple as drawing a parallel right across, so I don't mean a parallel, I mean a 90 degree. So let's just quickly try and draw a 90 degree right across. And what is this doing? This is just measuring the distance of that specific price channel. Now, if we draw that across, so that at least gives us the distance of that price channel. Then we measure that, and we're going to say here, so trusty notebook, running out of pages here. There we go. Okay, so trusty notebook is, let's call this trend A. So channel A is quite a volatile channel. That's what we'd be able to say. However, let's just quickly measure this here. This is coming out at 713, so it's roughly 700 pips. But let's just be more accurate. It's roughly 713 pips. I'm having hot chocolate here. It's quite a cold day today. Now this is a distance. So now we've done the exact same thing. So we've measured channel A, now we're going to measure channel B. So what is channel B telling us? Channel B, let's just quickly bring this line up. There we go. So I'm literally just measuring as simply as I possibly can. I mean, this is very, very rudimentary, but I'm just using it for the explanation of the video. So that is at 468. So channel B is sitting at a distance of 468 pips. Now, what is that able to tell us? Now, one thing we need to do is firstly try and visualize this entire thing. So what I like to do is something as simple as a percentile. So by using a percentile, let's just quickly get out of my very expensive calculator. I literally barely use this Apple product except for reading and calculating stuff. Okay, so once I have my calculator open, I literally just went to Google to use this. Then basically the simple thing I'd use is I'd go 468, so that's trend B. I'm already messing this up. Fat fingers, 468, and then divided by the total trend of 713. So what we're trying to find out here is what is the percentage that the entire trend has traveled between trend A and trend B. Now, times 100, just very simple. You're going to see here that it's a 65% move. So the market has moved by 65% from the channel B has moved now quite a considerable distance. And the thing is that what you would be able to say is channel B, so the answer is channel B has traveled 65% of the distance of channel A. So what is that telling you? That is telling you that based on our current trend, we are now moving way beyond where the current market is traveling to. So this average channel, this average price channel is traveling by roughly 468 pips. The first price channel, channel A, is traveling by roughly 713 pips. So what is that telling you? That is telling you that market, channel A, has a much higher level of volatility, but channel B does not. But now what do we have? We've got the market now pulling back and wanting to try and move into that higher volatility scenario. However, the thing that you can see on the chart here is we're getting to those historic lows. So the thing is that you take that, so you take the understanding that we're now moving into an extreme level. We're almost moving back to what channel A was providing us. However, why is that? That's because the market is trying to search for those historic levels. And that's what you can see here. So really focusing down onto the charts here, if we go onto the weekly charts, just to make it a little bit easier to notice, you can see over here how the market has developed a support level just right over here. So this level, very, very simply put, is quite a strong support level. However, what you can see over here as well, which is important to see, is that we have got these price wicks that is coming all the way down to this level, big market pullbacks, and then rejecting that level consistently. So as you can see over here as well, we've got more price wicks rejecting that level. So there's a strong level of rejection occurring here. And then you can see again coming up there is more price rejection again on this level as well. Now, what's really happening here is the market is wanting to try and reject this level, and historically going all the way back to 2016, you can see how it's consistently doing that. Then on top of it, if you gather up, for example, the look of the fact that the stochastic is becoming very oversold on multiple occasions, it's becoming oversold now again. You see how consistently, as it's been oversold in the past, you can notice how the market, when it becomes oversold, it begins testing those levels and the price wick bounces back. It constantly is pulling back because why? There's not enough momentum in the market to break through that price level. However, going back to this channel A and channel B, that is why you're seeing a much heightened level of volatility compared to what you've had in the whole of channel B. So what is happening? Price is now historically moving back to that previous behavior, and this is an important thing to realize. Now, how does this come back to risk? So we now know the market, so now we have an answer. Why is the market becoming so extremely oversold? Why is the market moving by so much, well, intended price momentum, but it really is just that extreme level of volatility. It's the market wanting to try and test a new level. But based on our idea, based on the fact that the market is entering extreme levels of oversold, historically low levels, we now know that at some point in time, professional traders, large investment banks, and big groups around the world will start to realize this, and they'll start to price in the risk of, do we really think the market is going to move beyond a historic level? The market is pricing a new historic level in certain indicators consistently time and time again as the market continues to move lower. Then if you have a look at multiple other forms of analysis, the price of it is really playing into the idea that although the market has moved way beyond where we thought it would be, the market is still standing strong against the idea itself. So what does that mean? We might have gotten into the position too early. However, because we've managed our risk correctly, we are able to hold on the trade and see how it plays out. Now, moving into this on a bigger aspect of risk, one thing you'll notice here is that in this idea, you'll notice how we have priced in additional orders as we moved lower. So we initially thought this was going to be our price level we'd be able to hold around, and we initially added positions there. However, that did not play out. So as the market has continued to move lower, we've ensured to add our positions where we feel as though the market is going to move to. Now, let's just put a simple example of price direction here. So let's say, for example, the market has moved all the way down to this level here, and our take profits are set more or less up in that level now as well. So by measuring half that distance, we can have a look at this. So now we've got a rectangle that's measuring the full distance of price and a rectangle that shows half the distance. If we look at the full distance of price from current point to target, so these are going to be the orange ones. So this is basically from where current price is to where we think it's going to go. We'd be able to move this down to the bottom. Now, if we take the converse and we do this from the previous high, so right up over here down to the previous low, and we just change the color of this. So a very simple process. We just change the color of that. Let's make it a different color. There we go. Oh, that's a horrible color, but anyway. We now then take this rectangle. Now I'm using very, very simple processes here to make sure you can all use it as well. And I'm literally just going to measure that right back to where that center point is, because I know when I click to select that rectangle, that is the center point of the rectangle. So I literally measure it all the way back there. So what is this showing us? This is showing us that the full movement of price from the high to the low is, what's the distance? 553 pips. So we're moving by roughly 553 pips. Now, have a look at that. Channel B, so we can say here, price high to low. So the green pricing here, the green rectangles, H to L, so that means high to low is 553, okay? Then we know that the low to high, the orange level, so from where price currently is to our targets are, we're sitting at 357. So low to high is 357, okay? Now, what do we know here? So we've got now 4 different numbers on this chart. So we know channel A was sitting at 730, and this is the important part. This is what wraps up the whole video. We know that channel A, the very volatile channel, we can just zoom out here and show that. We know for sure that that specific channel was moving by roughly 700 pips from the low of the channel to the high of the channel. That was very volatile. Channel B was moving by 468 pips roughly from the highs to the lows. But now the market, the current price high to low, which we noticed on this green side here, we now know that that is at 553 pips. So what does that mean? We're sitting almost directly between channel A and channel B's average price movement. So where do we price it? Do we price it as the behavior of channel A, or do we price it as the behavior of channel B? Well, the thing is that we have to price it as the behavior of channel A, because that is where the heightened level of volatility is. Now, because it's moving to those historic levels, we know, well, it's channel A's historic levels, as you can see on that support line. So that allows us to understand, okay, well, we now have to calm down, we need to de-stress, and not worry about the fact that the market is moving beyond the level we thought it would, because the market is assuming the behavior of channel A. Now, it might be slightly more complex to explain this, and to some people watching this video, they might be completely lost. And I understand. It's sometimes quite difficult to understand how the market has a behavior. The market doesn't act at random. The market behaves in a certain pattern based on the environment it is within. Now, the high to low is 553 pips. So we now know, we can confirm the market is behaving more like channel A than it is like channel B. So now that means we don't have to stress as much. But then the low to high, our current price target for the full price target is sitting at 357 pips. What is important about that number? That is the smallest number on this entire chart, on this entire page, because channel A is 700 pips. Channel B is roughly 470 pips. The price high to low is 553 pips, but the low to high target, so where price currently is to where our take profits are set, we are sitting at 357 pips profit. Now, what we know about that is, let's say, for example, we've taken our first order, and our first order is, so we have now here the TP. And our first order is sitting at, let's say, for example, I'll actually do it here. So our main orders are sitting at only 152 pips away. However, our furthest order is sitting at 357 pips away. So our furthest order is sitting at over double the distance that we think price is going to move. So what does that mean for us? If our initial order was incorrect and it's sitting 150 pips away, but our lowest order is sitting 350 pips away, and we can assume based on channel A's behavior that if now we have channel A's behavior and the price will return by roughly 700 pips, which is an assumption, I'm not telling facts, but we now know more or less that the market could return to that level. What does that mean? Now, 350 pips distance from low to high versus channel A's price behavior, that means we're probably going to hit that target pretty easily. Now, this is still an assumption, but that is what helps me de-stress, take the risk off, and not worry about the fact that, well, the market is not performing to my favor. The market is not doing what I wanted. However, because I've got low risk, because I know that the market, the idea, the general overlay of the idea is that it should play out over the medium to long term. And again, the behavior of channel A means the market is going to behave at some point in time within the parameters of where it wants to behave. However, whether it behaves like channel A or like channel B, it's either going to move back by 700 pips or it's going to move back by 470 pips. However, if my price target is 350 pips away, no matter whether it behaves like channel A or channel B, it should move all the way back to my target. But the thing is that I can even then go for half the price distance. I can go for 160 pips away, 170 pips away. I don't have to wait for the full 350 pips. I can wait until it moves back to my entry point. And as you can see over here, even looking at half the price distance, if I even cover 210 pips over here, I will recover all of my loss and make profits on the position. Now, some people call this a martingale strategy. It absolutely isn't. A martingale strategy is completely different. That's a gambling strategy. This is a strategy where you're averaging into the position, knowing that your initial order might be incorrect, however, managing your risk correctly so that you can add to the position at a later stage. It's a tactical entry. This is something that many professional traders all over the world use. And I've been able to work with these professional traders and realize that's how they really are covering a lot of their losing positions. It's not a bad strategy to use. It's not a risky strategy. As long as you manage your risk correctly, you will succeed. It's really that simple. Now, I know this video has run on quite a lot, but the thing is that these videos allow me to communicate with every single one of you about general ideas, general strategies, and ways and means that you can succeed more, that you can understand how to function better. However, I can't pack these into 10-minute videos. I can't pack these into little strategies. It is where I need to explain these over 10, 15, 20 minutes at a time, and sometimes running into a 30-minute talk. Now, there's nothing wrong with sitting in a video if you know it's educational, if you know it's helpful. We've been able to train students in over 28 countries around the world. So by default, I'm allowed to say I know what I'm doing because we have enough people that have told us that. Now, when it comes down to this is my general opinion. I'm not telling you what you should be doing. This is no Bible of how you should behave in the market. This is how I behave in the market. This is how I've succeeded. And over the last roughly 800 trades, I've had over an 83% win ratio. And those trades are just on my public portfolios. I have private portfolios as well. So I am able to at least say that I know what I'm talking about because I've used this strategy time and time and time again. Now, it's a difficult strategy, but once you understand better, you'll be able to succeed at it. Now, to anyone who wants to find out more about how to study with us, we do run a 12-month training program where we train students through an online training academy. It's a fully functional self-study platform, but every single week we all sit together, we talk about trade ideas, we talk about the news, the markets, called the Sunday Traders Talk. And what I'm going to do, to anyone who wants to carry on with this video, you can watch the excerpt from this in the second part of this video. So I'm going to upload a part 2 to this video. This is going to be the part 1, it will go up, but part 2 is going to be talking about how I'm going to be managing my risk on a very specific way of what I've explained to you now. That is going to be an interesting video for you to watch as well. So make sure to wait for part 2 of this video. I'll make sure to actually link it up in that little I button, as well as all the other videos you need. But to anyone who wants to find out more about training with us, you can email your request to study@msequitiestrading.com, or you can visit www.msequitiestrading.com. You can fill in a contact form, get hold of us, and we'll make sure to call you back and get hold of you, see how we can help out. Once again, everyone, thanks for tuning into this video. Stay subscribed or keep subscribing to make sure you get updated with all the weekly educational content. And I will see you in the next video. Cheers for now, everyone.